Hello everyone, let me know whether my audio and video is clear. Am I audible? So if my audio and video is clear, we can start. Please confirm in the chat section. So already in the previous class, we have discussed first chapter, nature, objective and the scope of audit. Now in the today's class, we'll be starting with the revision of second chapter. This second chapter would be ethics and terms of audit engagement. If you see in your ICI study material, this ethics and terms of engagement, it will be last chapter, 11th chapter. But in order to understand remaining other standards properly, we need to come in a flow. So this terms of audit engagement letter is the basic thing which you will enter into with the client before starting the engagement. So without discussion of concepts related to engagement letter, we cannot start discussion of all other standards. So what I have done, I have brought this that 11th chapter and I have kept it as second chapter in my book. So we will be covering this second chapter in the today's class. The weightage of this second chapter is 5 marks. You will be getting 5 marks from this particular second chapter. And this second chapter, you can divide it into two aspects. Firstly, we will be discussing about ethics. After completion of ethics, we will be discussing about engagement letter, that is SA-210. In the previous class we have covered SA-200, right? In the today's class we will be covering ethics and SA-210. So this will be our plan of action for the today's class. And if you have any doubts while I'm explaining, you can note them in the chart section. I will be seeing the chart section after half an hour or 45 minutes of the class, and I will be solving your doubts. Okay, I will not be continuously seeing the chart section while taking up the class. Okay, so if that is clear, we'll start with chapter number 2. So as I already told you, this chapter number 2, it is having two parts. First one, ethics. Next, terms of audit engagement. Now, ethics means, basically ethics means moral principles. Sir, what are these moral principles? See, these moral principles, they change from person to person. They change from society to society. A particular activity which is moral for a particular person might be immoral for another person. Let's say for example, now in society like India, getting two marriages, three marriages, having three, four wives, is it moral? It is completely immoral, right? Now, if you take same thing to the society like USA, there it is quite common to have three wives, four wives simultaneously, right? So, ethics are nothing but moral principles. This is morals. So, these morals, they change from person to person, they change from society to society. Okay, sir, we understood what is meant by ethics. Why these ethics are relevant to chartered accountants? See, not only chartered accountants, every profession, whether it might be doctors, whether it might be lawyers, every profession, they will be having their own ethics. So if you apply this concept of ethics to the profession, you will call it as professional ethics. So our ICAI, it has issued Code of Ethics. Already I discussed about this Code of Ethics in the previous class. Code of Ethics is 3 volumes of books. So in that 3 volumes of books, ICAI has prescribed various ethical requirements that chartered accountants have to comply with. So we will not be discussing complete 3 volumes, only fundamental principles we will be covering. Already fundamental principles, even SA-200 also discussed about fundamental principles, right? Yeah. So if you observe meaning of ethics, ethics are moral principles and they come from person intrinsically. That means within the person, from within the person, these ethical values have to come. In a given situation, whether a person behaves ethically or he behaves unethically, it completely depends on him, correct or not? So these ethics has to come intrinsically from the person, and these ethics also to a large extent they will be impacted by the society in which he has been brought up. So how he has been brought up, that also impacts the ethical values of the person. So it is inculcated in the habit of the person, and of course it is a state of mind. See, let's say in a particular situation a person is highly ethical. So he is going on a road. He found some 10,000 rupees on the road. Now, if that person is already having lot of money in the bank account, what he will do? He will try to act more ethically. He will take that 10,000 and he will go to police station and he will give complaint. Not complaint, he will give 10,000 and he will say that someone has lost 10,000 on the road. You please hand over to them. Like that, he will try to act ethically because he is already having lot of money in his bank account. Now, if the same person, there is no money in his bank account, he found 10,000 rupees on the road, what he will do? He will take that 10,000 and he will keep in his pocket and go away. He will not try to act ethically, correct or not? So if you are comfortable acting ethically, you will act ethically, otherwise you will not act ethically, right? So you cannot say that a person will be ethical always. It is not possible to say. So this ethics is a state of mind based on the situation, based on the circumstances. It varies whether you will be ethical or unethical, understand? So this is a brief discussion regarding meaning of the term ethics. Now I told you now, if you apply this concept of ethics to the profession of chartered accountancy, we will be calling it as the professional ethics. And ICAI has issued Code of Ethics. This Code of Ethics is a 3 volume of books which is containing fundamental principles. So all these fundamental principles chartered accountant must follow. Sir, what are these fundamental principles? Already I have explained in SA-200. Again, briefly I'll explain. First one is integrity. Integrity means being truthful, being honest. You have to report whatever is the actual situation. So if the entity has made a loss, you should not report that entity has made a profit. You should always be truthful. Understanding that is known as a characteristic of integrity. So auditor, chartered accountant must be always act in a integrity manner, understanding. Next, objectivity. What is meant by objectivity? This objectivity is related to decision making. So decision making can be of 2 types. It can be subjective decision making, it can be objective decision making. Subjective decision making means you make decisions based on your emotion, is known as subjective decision making. Objective decision making means you take decisions based on underlying facts. So tell me, should chartered accountant take decisions subjectively or objectively? Of course, he has to take the decisions objectively. Based on facts, he needs to take the decisions. Correct or not? That is objectivity. Next, confidentiality. This is very simple. Whatever the information that you obtain as a part of your work, the confidential information related to the client, that information you should not disclose to the third parties. You have to maintain utmost confidentiality. Next one is professional behavior. Of course, you are a chartered accountant, you have to behave professionally, right? And finally, professional competence and due care. Professional competence means skill, professional knowledge. So if any client comes to you and he gives a particular work to you, now only if you have knowledge, capability, skill to perform that work, you should take up that work. If you are not professionally competent enough to perform that work, then you should not accept that work. That is known as professional competence and due care. Due care means while exercising the work, you need to perform that work with utmost due care. You should not be negligent. Understanding? So those are the 5 fundamental principles which have been prescribed by Code of Ethics and which should be mandatorily followed by a chartered accountant. Now you can get a doubt, sir. Okay, sir. ICAI has issued Code of Ethics. In that Code of Ethics, there are certain rules, there are certain ethical requirements that chartered accountant has to follow. But why? Why should we follow? What is the necessity of these professional ethics? Why did ICAI has issued professional ethics? See, now if you observe the work that the chartered accountant does, what do you do in case of audit? In the objective of auditor, we have discussed, you will provide assurance to the users, right? So being a chartered accountant, being the auditor of a company, you are providing confidence to the users on the financial statements of the company, right? Now if you are unethical, if you are not having integrity, you don't maintain confidentiality, in such a situation, will client believe on you? No, client will not believe on you. So if a client is not at all having confidence on you, first of all, how will the client believe the confidence that you are giving on the financial statements? Correct or not? So in order to bring more respect to the profession of chartered accountancy among the public, all the chartered accountants must be ethical. That is the first requirement. See, to uphold the trust reposed on the CA services, public have kept a lot of trust on the services that the chartered accountants provide. To uphold that trust, to keep that trust as it is, we need to act ethically. The day when you don't act ethically, okay, the day from which you stop acting ethically, public will start losing trust on the services of chartered accountants. Getting it? Next, of course, enhance the confidence of the intended users. If you are of utmost ethical, then the assurance that you are giving on the financial statements of the company, users will be able to place more reliance on the assurance that you are giving, because they already know that this chartered accountant is utmost ethical. Whatever he says, that will be, most of the times it will be correct only. He will not say anything wrongs. Like that, users will get more confidence on your work. And of course, since our ICAI, our mother ICAI, it has issued Code of Ethics and told the chartered accountants to follow Code of Ethics, so we should follow. What happens if we don't follow? There is something known as disciplinary mechanism. So in the ICAI, there is a disciplinary mechanism. If any chartered accountant does not follow these Code of Ethics, disciplinary mechanism will punish that chartered accountant. Even your your name can be removed from the membership register. Understanding it? Penalty can be imposed on you. In the final, you will be having this professional ethics chapter will be there. There you will be seeing schedule 1, schedule 2, and what happens if you don't follow ethical requirements. There will be a complete disciplinary mechanism. Penalty up to 5 lakh rupees can be imposed on you, and your name can be permanently removed from the register. All these things can happen if you don't follow ethical requirements. Understanding? So deviation brings disciplinary mechanism. So these are the reasons why you need to follow professional ethics, and this is the need for professional ethics. Now, for complying with these professional ethics, there are two approaches. So a chartered accountant can comply with the professional ethics through two approaches. First one is principle based approach, next one is rule based approach. See, in both of these approaches, chartered accountant ultimately he will comply with ethics, but the routes in which he comply with the ethics will be different. So one is the principle based approach, another one is rule based approach. Sir, what is this principle based approach? What is this rule based approach? I will give you an example for this. With that example, you will be able to understand it more easily. So, firstly, principle based approach. Let's say, for example, the requirement is that as on 31st March, there will be inventory closing stock in the books of accounts of the company, right? Let's say there is a closing stock of 10 crore rupees. Now, the requirement is that auditor has to physically verify this inventory that is present as on 31st March, right? So, for physically verifying the inventory, what the auditor has to do? Auditor has to attend the location of the entity on 31st March for physical verification, and he has to verify the stock physically, right? So, the principle is that you need to obtain audit evidence relating to existence of inventory as on 31st March. That is the principle. Now, you started to go to the godown of the entity on 31st March. Suddenly, huge rain and floods have come. Huge floods has come. Huge storm has come. So, which has made impossible for you to move out of the house. Understanding? So, on 31st March, you are not able to go to the entity's location for performing physical inventory verification. Now, what you will do is, let's say you are following the principle based approach. If you are following the principle based approach, here what you will do is, let's say after 3 days, complete floods is gone, rain is also stopped, everything has become normalized. Now, on 4th April, you will go to the location of the entity and you will perform physical verification of inventory. Sir, if we perform physical verification of inventory on 4th April, we will get evidence about inventory that is present as on 4th April. But auditor wanted evidence as on 31st March. Yes. So, here what you will do, you have got evidence about physical inventory as on 4th April, right? Now, you will verify the purchases that have been made during this period, and you will reduce that purchases from this amount, and you will also verify sales made during this year, during that period, during that 3 days, and you will add the sales, cost of sales you will add. So what you will get? You will get closing stock as on 31st March, correct or not? So here, what did you do? You have achieved the underlying principle, correct? So the principle is you have to obtain audit evidence about inventory as on 31st March. You did not follow the same procedure. You did not attend as on 31st March. But by following a different procedure, you have achieved the underlying principle. You have got evidence about the inventory as on 31st March by following this procedure, correct or not? So this is nothing but here you have used principle based approach. So under principle based approach, what happens is you will not follow exact procedure, but you will achieve underlying principle. Getting it? Yes, sir. Next, if you follow rule based approach, same thing. Take same example, you are following rule based approach, then what the auditor will do? If the auditor is following rule based approach, as on 31st March, he needs to verify uh, physical inventory verification, right? Now, on 31st March, huge rains, flood is coming, auditor will not listen. Auditor will become Balaya. I don't care. I will go on 31st March only. I will take my boat and I will go in my boat. So, auditor wanted to strictly follow the rule. Same procedure auditor wanted to follow under rule based approach. Getting it? So, either in principle based approach or in rule based approach, in both the approaches, you will achieve underlying principle, but you will follow different rules. Getting it? Here in rule based approach, you will exactly follow the given rules. You will not go side. Understand? You will not deviate with the rules. But in principle based approach, you will not focus much on the rules, but you will try to achieve underlying principle. Getting it? I hope this is clear to you. If you are having any doubts, you can let me know in the comment section. I guess there is no doubt with respect to this concept. So see, principle based approach and rule based approach. Under principle based approach, what happens? You will comply with spirit of ethics, underlying principle you wanted to achieve, underlying purpose you will try to achieve. Okay, you will not try to do it in the same fashion. You will not focus much on the procedure. Understanding? Here you need to exercise professional judgment. So how I can achieve the underlying principle? If I am not able to perform this activity, by performing which other activity I can achieve the underlying principle, like that you will focus under principle based approach. Whereas under rule based approach, strictly follow the rules. It is narrow outlook and somewhat rigid because it doesn't allow for the deviation, right? Next, about independence. See, about independence already we have discussed in the previous chapter, right? Only some portion we have discussed. Meaning of independence we have discussed, that's it, right? Still there are a lot of discussions with respect to independence, like threats to independence we need to discover, we need to discuss that threats to independence we will cover. Okay, so here, apart from following ethical requirements, chartered accountant should also act independently if he is providing assurance, right? So independence means judgment not subordinate to wish or will of others. So whatever the decisions that you take, you should not take those decisions based on wish or will of management or any third person. You have to completely be independent. Now this independence can be of two types. Perspectives for this independence can be of two types. One is independence of mind and independence in appearance. Sir, what is this? What is independence in mind, independence in appearance? See, independence in mind means actually that person is independent. Okay, in his mind he is actually independent. He knows that he is acting independently. He is not dependent on anyone. He knows that. Okay, that is independence in mind. He knows that he is acting independently. Independence in appearance means, see, now this is the auditor, right? And this is the client. Okay, now auditor is providing services to the client. Okay, there is a third party. Okay, there is a third party. Now this third party, when he sees the relationship between auditor and client, he should feel that yes, this auditor has not lost his independence. He did not lost his objectivity, like that some third party should feel by seeing at the relationship between auditor and the client. Then you will call it as this auditor is independent in appearance also. Getting it? So that is independence in mind and independence in appearance. So is it required that auditor should be both independence in mind and independence as well as in appearance also, or is it sufficient auditor is independent in mind and not independence in appearance, or auditor is independent in appearance but not independent in mind? The answer is you need to be both independence in mind as well as independence in appearance. Getting it? Even though you are not independence in appearance, that's okay, that's fine to some extent, but you should be independent in mind. That is 100% mandatory. Okay, now moving to threats to independence. Threat means, what is meant by a threat? Threat means something that prevents the person from doing a particular activity. Here in this situation, threat to independence means something that prevents the auditor from acting independently is known as a threat to independence. Understood what is meant by threat? So see, threat means something that prevents auditor from being independent. Now there are 5 threats to independence. We will discuss each of these 5 threats along with examples. We will discuss. First one is self-interest threat. What is this self-interest threat? You need to remember that this self-interest threat, it will be always in monetary terms. Means, let's say Mr. A is a chartered accountant. He has invested in the shares of a particular company. Now Mr. A has also been appointed as auditor of that particular company. Now here Mr. A is having interest in that company in the form of shareholding. So if he is appointed as auditor of that company, he cannot act independently. This is known as self-interest threat. Your interest in the threat will prevent you from acting independently. Getting it? Next, self-review threat. Self-review threat is very simple. You only performed the work and you only reviewing that work. Like let's say for example, financial statements. Financial statements of a particular company. You only prepared the financial statements and you are only appointed as auditor of that company. So you are reviewing your own prepared financial statements. What happens? If while auditing those financial statements, if you find any misstatements and you go to the management, there are certain misstatements in these financial statements, then what management will say? Array auditor, you only prepared those financial statements now. Like that the management will say. Correct or not? So you cannot act independently if you review your own work. So that is self-review threat. Next, advocacy threat. Advocacy threat means, see, advocacy means promotion. Okay, promoting the client. Okay, promoting the client is known as advocacy. So you have promoted the client to such an extent that public started feeling that there is no independence between auditor and the client. Like let's say for example, client has planned for going IPO. Okay, he wanted to list his shares in the stock market. Now you being auditor of the client, you have promoted the client like anything. You told to everyone, your clients, your the public, everyone, you told that this company is a very good company, highly profit making company, huge returns you will get. You purchase the shares of the company like that. You promoted the company like anything. Now based on your words, everyone purchased in the purchased shares of that particular company. After 2 years, 2 years have passed, you came to know that this company is a number one fraudulent company. There are a lot of misstatements in the financial statements of company. So whatever company has furnished to the stock exchanges, whatever company has furnished to the public that it has earned this much profit, all is fake. Now tell me, you are only auditor of the company. Can you give qualified report for the company? If you give qualified report for the company and say that this company is a fraudulent company, number one fraudster company, then what the public will do? They will be in front of your house. Array auditor, you only told to invest in the company based on your words, we have invested. Like that, public will fall behind the auditor, correct or not? So auditor will lose his independence if he promote his client. Understanding? So this is a advocacy threat. Next, familiarity threat. Familiarity threat is very simple. You are acting as auditor of that company for the past 20 years. So for the past 20 years, every year you are only auditing the company, means you would have developed a nice bonding with the client. You would have developed a nice relationship with the with the client, correct or not? Now, after being auditor of the company for the past 20 years, now that company is struggling financially. It came to the auditor and told the auditor that, auditor, in the current year we have made losses. Our business is not performing good. If we report these losses as it is, our share market, our shares will fall down. We will report it as a profit. You please don't mention it in the report. You say that the financial statements are showing true and fair. You like that, you please give the report just for this 1 year. Like this, client will come and request to the auditor. Now auditor already became friend of the client. Auditor cannot say no to the client. Understanding? So you will agree. So this is nothing but a familiarity threat. You might lose your independence because of the familiarity that you have gained with the client. Next, intimidation threat. Intimidation threat means client is threatening you. Intimidation means threatening. So client is saying that, see auditor, if you qualify my audit report, I will remove you as an auditor. Our client is saying that, let's say for example, client is having 30 years of experience. Okay, from past 30 years it is doing this business. Auditor is recently qualified auditor. Okay, the chartered accountant recently qualified, just 2 years experience he is having. He is doing audit of this company. Now he found out a particular accounting treatment in the financial statements and told that the company, as per Indian accounting standards, this accounting treatment is wrong. You should not do it like this, he told. Company said that, array auditor, you are just 2 years experience you are having. We have been doing this accounting treatment for the past 30 years. We are doing it like this only. No one said anything to us. You bacha auditor. Okay. Only 2 years experience you are having. You are questioning us like that. The client is threatening to the auditor. Auditor also feels that, acha, for the past 30 years they are doing like this only. None of the auditors questioned that. Might be I am only wrong. Like that the auditor might think. Right. So that is intimidation threat. Getting it? Now, there are these 5 threats, right? 5 threats to the independence. Now, knowing that there are threats to the independence, so auditor, chartered accountant, he knows that there are these threats to the independent. If I accept this engagement with this client, there are these threats to the independent. Knowing that there are these threats, will the auditor be silent? Will he just accept the engagement like that? No. What he will try to is, he will first of all try to eliminate those threats. Understanding? If there are these threats, I cannot act independently. So if I have to act independently, I should eliminate these threats. That is the first option that is available. Sometimes some threats cannot be eliminated. So if a threat cannot be eliminated completely, I will check, auditor will check whether I can implement safeguards at least. By implementing safeguards, can I bring that threats to an acceptable level? I will check that. So, okay, I am not able to completely eliminate the threat. Can I at least implement a safeguard? Safeguard means nothing but, let's say for example, you have got a familiarity threat. Okay, you have got a familiarity threat. Means for the past 10 years, you are only doing the audit. So, in your audit firm, A, B, C and co chartered accountants, 3 qualified chartered accountants are there. So, from the past 10 years, Mr. A only acting as engagement partner of the company. So, Mr. A has become very much familiar. Now, what you can do is, as a safeguard, you can say like this. See, from this year onwards, every 2 years engagement partner has to change. So for the first 2 years, Mr. A will act as the engagement partner of the company. For the next 2 years or 3 years, Mr. B should act. For next another 2 or 3 years, Mr. C will act. Like this, there should be rotation of the engagement partner. So by implementing this safeguard, you can at least reduce that threat, familiarity threat to an acceptable level. Correct or not? So you will see that whether you can reduce that threat to acceptable level. See, eliminate the threat completely or put the safeguards to reduce threat to acceptable level. If it is not possible to eliminate, if it is not possible to put safeguards, then the only option is you don't accept that engagement, or already if you have accepted, withdraw from that engagement. Okay, desist from doing that particular task. See, desist from task or do not accept the engagement. Clear? Yes, sir. Clear, sir. Now, professional skepticism. This professional skepticism also already in first chapter itself I explained you, right? Difference between professional judgment and professional skepticism I told you. So what is meant by professional skepticism? Professional skepticism is a quality of auditor which includes being alert. So during the entire audit, auditor should be very much alert to the misstatements, very much alert to the frauds, right? Next, he should always have a questioning mind throughout the audit. So whatever he sees in the audit, whatever evidence he gathers, he needs to continuously question it. Understanding? And finally, whatever the evidence he gathers, he need to critically assess that evidence. You should not just take it and keep it in your audit file. You need to assess it, whether this evidence is correct only, or is it a fake evidence. Is this evidence sufficient for my purpose, or should I obtain some more evidence? Understanding, is this evidence appropriate for my purpose? Like that, you need to critically assess whatever the evidence you have obtained. Getting it? See, professional skepticism is the attitude that includes questioning mind, critical assessment, and being alert to possible misstatements. So what could be possible misstatements? Some of the examples of a possible misstatement, see, such as contradicting evidence. Contradicting evidence means you have obtained two evidences, both are not matching, is known as contradicting evidence. Let's say, for example, company has made credit sale to a particular customer, Mr. A. 1 lakh rupee credit sale it has made. In the sale invoice, it is showing it as 1 lakh rupees. That means company has to receive 1 lakh rupees from the customer, right? In the sale invoice, it is showing like that. Now, in the books of accounts also, it is written as 1 lakh rupees. You have sent the external confirmation to Mr. A. Mr. A, in the books of accounts of the company, it is showing that you have to give 1 lakh rupees. Is that correct? Like that, you have asked for external confirmation. Mr. A gave a confirmation stating that no, I should not give 1 lakh rupees. I have to give only 80,000 rupees. Now, sales invoice, which is the evidence showing 1 lakh rupees, external confirmation, which is also one of the evidence telling 80,000 rupees. So there is a contradiction between the evidences. In this situation, you need to be very alert to identify which one is correct. Understanding? That is known as contradicting evidence. Next, questions about reliability of documents. So whatever the documents which the management has submitted to me, can I rely on them? Can I place my reliance on them? Next, possible fraud. You should also be very alert to identify whether there are any frauds in the organization, and you should also be alert to circumstances suggesting need for additional audit procedures. So this is a discussion with respect to first part, that is ethics. Now we'll be moving to the second part, which will be terms of engagement letter. I guess there are no doubts. Yeah. So moving to the second part, which is SA-200, agreeing to the terms of engagement letter. So agreeing to the terms of audit engagement. See, the audit that a chartered accountant provides to the client Is it a service? Yes, it is a service. Now, when you are providing a service to a client, should you enter into an agreement or not? Yes, of course, you should enter into an agreement discussing what will be the terms and conditions related to this service, what will be the responsibilities of auditor, what will be the responsibilities of management, what will be the fees, what will be the scope, what will be the objective. Discussing all these things, should there be a agreement or not? Yes sir, there should be agreement. This agreement between the auditor and the client, technically we will call it as engagement letter. Okay, now what will be the terms and conditions of engagement letter? That is one of the concept that we are going to cover in this particular standard. Basically this entire SA-200, it deals with engagement letter and also something known as preconditions. So when a client comes to you, so you are a chartered accountant, you have opened your practice. Now a particular client has come to you offering a particular engagement. So they are having a company, they wanted you to act as auditor of that particular company. Now if client gives you that work, immediately will you accept it? No. Before accepting it, you have to check certain preconditions. Only if that preconditions are present, you will accept the engagement. If preconditions are not present, you will not accept the engagement. So what are those preconditions? That also we will be covering in this particular standard SA-200. Clear? See, this standard deals with, first thing this standard deals with, when to accept or continue the audit, that is preconditions. So in order to accept a particular audit engagement, preconditions should be there. What are these preconditions? We will be discussing it. And there should also be common understanding between client and the auditor. Common understanding means there will be engagement letter, right? In the engagement letter, whatever the terms and conditions have been written, there should be common understanding between client and the auditor with respect to that terms and conditions. Understanding, if auditor is saying that I will be providing only reasonable assurance, client should understand what is meant by reasonable assurance. Client should also think that it is reasonable assurance only, not absolute assurance. That is known as common understanding. Getting it? So there should be preconditions present and there should be common understanding of the terms between client and the auditor. Only if these two are present, you will accept the engagement. So now we will see what are preconditions. See, preconditions to accept the engagement. Now, first of all, when a client comes to you, the first thing that you will ask as an auditor is, what is the financial reporting framework as per which you have prepared your financial statements? Client will say, we have followed accounting standards for preparation of financial statements. Now, auditor will ask, you are a listed company now. For listed company, Indian accounting standards is applicable now. Why did you follow accounting standards? Company said, we don't know how to prepare financials as per Indian accounting standards. We know only accounting standards. So we followed accounting standards. Now, tell me, is that financial reporting framework which the management has used, that is accounting standards, is it acceptable to the auditor? Being a listed company, you have to follow Indian accounting standards. You followed accounting standards. So is that financial reporting framework acceptable to the auditor? No, auditor will not accept that financial reporting framework. So the first precondition is financial reporting framework that the management has used should be acceptable to the auditor. See, acceptability and suitability of financial reporting framework. If the financial reporting framework is not acceptable, straight away you will say, no, I cannot do this audit until and unless you prepare the financial statements as per that Ind AS. Getting it? Yes. Next, one more thing. Management should give an undertaking, that means a written agreement to the auditor stating that it is the responsibility of the management to prepare financial statements. So management should agree to their responsibility of preparation of financial statements. Management also should agree to their responsibility of establishment of internal controls. Management also should agree that management will provide access to all the information that is required for the purpose of audit. Management will also provide additional information that the auditor might ask, and management also will provide access to people in the organization so that auditor can ask questions to them and auditor can get information from them. All these responsibilities management should agree. This is also another precondition. See, management understands and acknowledges its responsibility to prepare financial statements, to establish internal controls, and to provide the auditor with access to all the documents, information, and records. Additional information that the auditor might request, and unrestricted access to persons in the entity to obtain audit evidence. So, management should agree for these responsibilities. These are the preconditions. Only if these preconditions are there, auditor will accept the engagement. If preconditions are not there, you will not accept the engagement. So that is the first thing which is done and dusted. Next, moving to engagement letter. So what is this engagement letter? See, with respect to engagement letter, we will be discussing what content should be present in the engagement letter, that is the terms and conditions, what should be the form of engagement letter, and if at all you wanted to make any changes to the engagement letter, what is the procedure. These aspects we will be covering with respect to engagement letter. Okay, so if you see engagement letter, as I already told you, it is an agreement between whom? Management and the client, right? So see, agreement between not management and client, auditor and client. So agreement between auditor and management about the terms of engagement. So what terms will be there in the engagement? First of all, objective and scope of audit. So objective and scope of audit. So what are the objective of audit? In SA-200 we have discussed not to obtain reasonable assurance that financial statements as a whole are free from material misstatement whether due to fraud or error. That entire objective you will copy paste here, getting it. And scope of audit also. In the first chapter itself, we have seen scope of audit, what will be included in the scope of audit, what will be excluded in the scope of audit. So that inclusions also you will copy paste in the engagement letter. Next, responsibilities of auditor. So what are the responsibilities of auditor? To perform audit procedures, to obtain reasonable assurance, and to give opinion in the form of audit report. All these are the responsibilities of auditor, right? We will be discussing the clear responsibilities of auditor in SA-700. The format of audit report we will be seeing. There we will see the complete list of auditors' responsibilities. So all that auditors' responsibilities you need to clearly mention in the engagement letter. After auditor's responsibilities, management's responsibilities also you need to clearly mention in the engagement letter. What are the responsibilities of management? Just now we have seen preparation of financial statements, establishment of internal controls, providing access to the auditor with respect to all the information, additional information, and any people in the organization. That is the responsibilities of management, right? Next, identification of applicable financial reporting framework. This is important. Now, see, while accepting the engagement, management might say that auditor, we have prepared our financial statements as per Indian accounting standards. Management told this. Now, since management told that they have prepared as per Indian accounting standards only, you did not include that point in the engagement letter. You have accepted the engagement directly. When you went to the company for doing the audit, you found that financials are prepared as per accounting standards. Now, when you went to the management and asked management, you told that you prepared the financial statements as per Indian accounting standards, but there is accounting standard financial statements. What is this? You asked me. Is management is telling, no auditor. When did I say that I prepared as per Indian accounting standards? I told you that we have prepared as per accounting standards only. Like this, the management can say, correct or not? So to avoid that, better clearly mention in the engagement letter itself which financial reporting framework you have followed for preparation of financial statements. Getting it? So identification of applicable financial reporting framework. Next, form and content of reports to be issued. See here, this is also important. Now form and content of reports to be issued means form and content of report to be issued by the auditor. Now audit report, what content will be there in the audit report, what type of opinion auditor will give in the audit report, that will be known to the auditor only after completing the audit. Correct or not? So in your audit report, whether emphasis of matter paragraph you will keep, whether other matter paragraph you will keep, which type of opinion you will give, the content, the complete clear content of the audit report you will get to know only after audit is completed. Correct or not? Yes. But engagement letter is prepared before starting the audit. Correct or not? Now they are saying in the engagement letter, auditor should mention form and content of audit report. How can auditor can mention? Because the form and content of audit report auditor will get to know only after completing the audit. Before the audit only, how can he mention? He cannot mention. Correct or not? Then why they are saying this point here? See, here as per SA-700 we are having a basic format, right? So basic format he will mention that my audit report will be in this fashion, he will say, and he will mention that the report format that I have mentioned, that is subjected to change after I complete the audit. So once I have completed my entire audit, this format of report might be subjected to change. That disclaimer point you need to mention. Understanding? Yes, sir. Next, one more important point. Now, see, you and the client, both of you have entered into a engagement letter, a proper well drafted engagement letter you have entered and started the audit. So see, auditor, okay, this is the auditor, he started doing the audit. So he is doing the audit. In the middle of audit, okay, in the middle of audit, let's say somewhere here, in the middle of audit, client came and told the auditor, we wanted to change the terms of audit engagement. In the engagement letter, we have written some terms. We wanted to change that to terms and conditions. Now, whether auditor can accept that change or should he not accept that change in the terms of audit engagement letter, because he has already accepted engagement and he also started doing the work. Now in the middle of work, client is coming and asking to change the terms of audit engagement letter. What should be the action of auditor in this situation? Here, first of all, auditor should ask the management, you wanted me to change terms of engagement letter. Acha, why? What are the reasons? So you will ask the reasons for the change. Now management will say reasons, so and so reasons, that this management will say. Now you will see whether the reasons given by management, are they justifiable, are those reasons reasonable. Okay, there is a specific term, reasonable justification. So is there a proper reasonable justification behind the reasons that the management is giving? So you will check, are those reasons having reasonable justification? Now what is meant by reasonable justification? What is meant by reasonable justification? Standard itself has defined what is meant by reasonable justification. Only in two situations you can call it as reasonable justification. Okay, if management has given any of the two reasons, you will call them as reasonable justification. Otherwise all other reasons will be unreasonable justification. Sir, what are those two reasonable justifications? See, first of all, change in the requirements of the management. Change in the requirements means, let's say the company, it wanted, not company, the entity, it wanted to take loan from the bank. So it has went to the bank asking for a loan. Bank people, they told that, see, in order to give you loan, we wanted your audited financial statements. This entity, this business entity, let's say it is partnership firm, it never got its financial statements audited. So it went to the chartered accountant and told the chartered accountant that chartered accountant, we wanted to take loan from the bank, and for that loan they are asking audited financial statements. Please do audit of our financial statements and give audit report. Okay, engagement letter drafted, all the terms and conditions properly framed, and auditor started doing the audit. In the middle of audit, what happened is bank manager called the management of the company and told that sorry, not company, partnership firm, uh, entity, I told you that audit report is required for the loan, right? Actually the audit report is not required. It is sufficient if review report is given. Audit is not required, that is reasonable assurance is not required. It is sufficient if limited assurance report, review report is given. Now the requirement of entity has changed. Earlier for getting loan it wanted a audit, reasonable assurance engagement, but now for getting the loan it wanted a limited assurance review report. So it went to the auditor and told that auditor, our requirements have changed. We wanted review, not audit, so please change the terms of engagement letter so as to provide only limited assurance but not a reasonable assurance. Now this reason will be considered as reasonable justification. Understood? So if management has asked the auditor for change in the terms of the engagement letter because of change in the requirements of the management, auditor needs to consider it as reasonable justification. Understood? What is the second situation in which it would be considered as reasonable justification? If there is a misunderstanding of terms of engagement. That means, see, in the engagement letter it has been mentioned by the auditor that we will be doing audit, we will be providing a reasonable assurance, like that it has been mentioned. Now management, auditor started doing the audit, and management, it also started providing information that is asked by the auditor. Now auditor is asking a lot of information, he is taking a lot of time. Management is thinking that we wanted review, for review this much time will not take. Why the auditor is taking this much time? Like that management went to the auditor and said, see, auditor, why you are performing all these procedures? We just wanted a review. For the review, this many procedures I guess not required now. Now auditor said that you asked for review, in the engagement letter we have written as a reasonable assurance. Now management has misunderstood. Understanding, management, see, what is meant by reasonable assurance, what is meant by limited assurance, what is meant by absolute assurance. Since we are chartered accountants, we are reading the subject of audit, we will know. Management, they, what will they know? What is the difference between reasonable assurance, limited assurance? How will they know? They don't know. So at the time of signing the engagement letter, reasonable assurance means they thought that reasonable assurance will be given in case of review. They thought like that and they have started engagement. Understanding? So later on they came to know that there is a difference between reasonable assurance and limited assurance, and they wanted a limited assurance but not reasonable assurance, and they have approached the auditor for change in the terms. Here management has misunderstood about the terms of the engagement and requesting the auditor to please change the terms of engagement from audit to review. Getting it? So in this situation also it will be treated as a reasonable justification. Understanding? So in these two situations, if management is asking the auditor to change the terms of audit engagement because of these two reasons, auditor will accept the change of terms. If management is asking the auditor to change in the terms of engagement because of some other reason, not these two reasons, then auditor will not accept the engagement. Understanding? What could be some other reason, sir? See, let's say for example, auditor, he is verifying debtors. Now while verifying the debtors, he is sending external confirmations to all the debtors. Now management came and said, auditor, don't send external confirmations to the debtors, because in these debtors, some debtors are fake debtors. Management know that some debtors, fake debtors, it has booked in the books of accounts in order to book fake sales. Now if auditor sends external confirmation to all these debtors, it will be found out that the debtors are fake debtors. So management wanted to change the terms of audit engagement, mentioning that auditor should not send external confirmation to debtors. This term management wanted to include in the engagement letter. Now auditor asked the reason. Management is saying some other reason, whatever reasons it wanted, it's saying, but the actual reason is this: there are fake debtors. So management wanted to avoid auditor from sending a confirmation to these fake debtors. So if because of this reason management is asking for change in the terms of engagement letter, will auditor accept it? No, auditor should not accept for change in the terms of engagement letter that is requested by the management. Getting it? Yes, sir. So see, I hope this is clear to you. Yeah. So see, if management requests for change in the terms of audit engagement, and he will ask for reasons. If it is reasonable justification, what is meant by reasonable justification? Change in entities requirement or misunderstanding of the nature of service. If these two are the reasons, it will be treated as reasonable justification. Any other reason, it will be treated as unreasonable justification. Yes, it is a reasonable justification. Then you will accept the change in the terms of audit engagement. Now while accepting the change in the terms of audit engagement, you will see whether work performed till date might be relevant. See, here in this timeline, auditor has performed some procedures for the purpose of audit, right? Here management came and told that we wanted to change the terms of engagement to review, right? Now from this point of time, auditor will perform review, right? Now for the purpose of review, some of the procedures that he has already performed during the audit might be useful, correct? So some of the procedures that he has already performed during this audit, these procedures as it is can be useful for the review also, correct or not? So auditor needs to check that before accepting the change in the terms of audit engagement. Auditor has to once check whether the procedures that I have already performed, can I use that procedures for the upcoming engagement review, the changed engagement? That needs to be once considered by the auditor. Understanding? Yes, sir. Next, legal or contractual implication. So once I agree to change in the terms of audit engagement letter, what are the contractual implication? Should I enter into a new contract, and should that new engagement letter should it be again signed? Of course you have to enter into new engagement letter including the changed terms in that engagement letter, and that new engagement letter should be again signed by you and the client, right? Next, report shall not refer to original audit engagement. That means, see, here at this point the terms of engagement has been changed, right? So from this point you are performing review, right? So once the review is done, you will give review report, correct? Now in this review report that you give, you should not mention anywhere about the previous audit that you have performed. Getting it? So you should not say that, see users, previously I have been appointed for doing the audit. In middle, management came and asked me for change in the terms. After change in the terms, I have started doing review. Not required. Okay, explaining all these things about the previous engagement, not required, because unnecessarily users will get confused. Okay, from this point you started doing review na, You give review report. Don't mention about the previous engagement in that review report. Clear? See, about review, we have already discussed in the previous chapter, chapter number 1. If you see that chapter number 1, you will clearly understand what is meant by review. I almost discussed it for 15-20 minutes in the previous chapter. Okay. So, yes, what if the justification given by management is not reasonable? So management has not given reasonable justification, and management does not permit the auditor to continue the engagement with original terms. Then better withdraw from the engagement. Understanding? You will withdraw from the engagement. Next, see one more important thing. Note, if law or regulation prescribes above terms, auditor need not record them in agreement. That means, let's say for example, you are doing a bank audit. Now, the terms and conditions that are applicable for the bank audit, let's say they are already prescribed by RBI. Okay, in the RBI Act, detailedly it has been mentioned the terms and conditions that are applicable with respect to the audit of a bank. In such a situation, since those terms and conditions are already present in the law or regulation, you need not again enter into separate engagement letter with the bank. Getting it? Yes, sir. Next, limitation on scope prior to engagement acceptance. Limitation on scope means what? Who will put a limitation on scope? Management will put a limitation on scope. On whom management will put a limitation on scope? On auditor, management will put a limitation on scope. That means, see, auditor, while doing the audit, he has to send external confirmations. He has to perform physical verification of assets, inventory, all these procedures he has to perform. Management is saying that, auditor, you should not send external confirmation, you should not attend physical inventory verification. All these things are nothing but putting a limitation on the scope of auditor. Getting it? So if management puts limitations on the scope of auditor before accepting the engagement, see, if auditor feels that these limitations will result in auditor disclaiming the opinion, so with these limitations, if I accept and I do the audit, at the end in the report I have to disclaim my opinion. Like this, if auditor feels, then better not to accept the engagement. Accepting the engagement and giving a disclaimer of opinion, instead of giving disclaimer of opinion, it's better not to accept the engagement in the first place with these limitations. Correct or not? So auditor shall not accept such an engagement. Getting it? Yes, sir. Got it, sir. So we will be completing this chapter. Another 5 to 10 minutes we will be completing this. Next, recurring audits. What is this recurring audits? See, recurring audits means, let's say there is a company A Limited. Now for the A Limited, in the first year, Mr. B has been appointed as auditor. In the second year, Mr. C has been appointed as auditor. Okay. Again in the third year, Mr. C only appointed as the auditor. Okay. Now for Mr. C, third year audit engagement will be recurring audit. Why? Because in the previous year also he only did the audit, and again in the current year also he only doing the audit. So this audit will be recurring audit for Mr. C. Getting it? Let's say again in the fourth year, Mr. B has been appointed as auditor. Now tell me, for Mr. B, will this fourth year audit, will it be initial engagement or recurring audit? It will be initial engagement. You should not say that, sir, auditor, this Mr. B already did the audit for first year, so it should be recurring audit for Mr. B. No, you have to just check whether in the previous year he has done that audit. In the previous year, some other auditor has did that audit, and he is doing this audit for the first time in this year, right? So it will be treated as initial audit engagement, but not a recurring audit. Getting it? Yes, sir. So my question to you is, see, here Mr. C, for this for the second year audit engagement will be initial audit engagement for Mr. C. Correct or not? Now, in the initial audit engagement, Mr. C will give engagement letter to the client, right? Being auditor, being appointed for the first time for the client, you will give engagement letter to the client. Next year, third year also, you only got appointed as auditor. Now, should you give new engagement letter to the client, or can you continue the same engagement letter as it is? So, should you give an engagement letter to the client in the third year because it is a recurring audit now? Already in the previous year you have given engagement letter. Should you again give in the current year also? The answer is it depends. So, if certain circumstances are present, you might have to give new engagement letter. Otherwise, you might decide that okay, new engagement letter not required. So, what are those circumstances that we will be seeing? Okay. So, circumstances in which new engagement letter should be given. See, recurring audits. What is meant by recurring audit? Recurring audit means a audit which is performed by an auditor over the years. Okay. Now, the question is a new engagement letter required for recurring audit? It depends on the following factors. See, following factors may make it appropriate to revise the terms of engagement. So, what are the situations? See, if there is any indication that entity has misunderstood the scope and objective of the audit. So, in the second year, auditor Mr. C, he has given the engagement letter. Audit done. Auditor felt that management has not understood the scope and the objective of the audit properly. Auditor felt like this. Now again next year also same auditor has been appointed by the management. Now auditor is having a feeling that in the previous year management has not understood the engagement scope and engagement objectives properly. So what he can do is in the current year he can frame a detailed engagement report explaining clearly about the scope and objective and give this new engagement letter to the client in order to avoid that misunderstanding which management has faced in the previous year. Understanding? So this is one of the situation in which auditor can consider giving new engagement letter in case of recurring audit also. Next, if there is any revised or special terms, of course, if the terms of engagement has changed when compared to the previous year, you have to give a new engagement letter. There is no option in that, right? Next, change of senior management. Senior management means managing director or whole-time director or CEO. So these senior management who were present in the previous year, they are not there in the current year. Some new people has come in the current year. So since these people are new, they might not be having knowledge about the engagement letter that you have given in the previous year. In the previous year, you have given engagement letter to some other people who are the top management. In the current year, top management changed. So it's better to give engagement letter once again to them. Understanding? Even though it is a recurring audit, better to give engagement letter once again to them. Next, change in the ownership. Same. If there is change in the ownership when compared to the previous year, better to give engagement letter again to the new owners. Next, significant change in nature or size of the entity's business. In the previous year, the company was the turnover of company is just 10 crore. In the current year, company's turnover increased to 1000 crore. Now, since the size of company has increased, the way in which you do the audit of company will also change, right? The engagement letter which was okay for a company with a 10 crore turnover is not sufficient. For the company with 1000 crore turnover, you have to perform more procedures, more terms and conditions will come into engagement letter. Correct or not? So in this situation, you better give a new engagement letter, a changed engagement letter suitable for the size of the company, suitable for the changed size of the company. Next, change in legal or regulatory requirements. So there has been a change in the law or regulation because of which the way in which you perform audit has changed. So you better give a new engagement letter as per the latest law and regulation. Next, change in financial reporting framework. In the previous year, company has followed accounting standards. Now company in the current year, company has become a listed entity and it has to follow Indian accounting standards. So it has prepared its financial statements as per Indian accounting standards. Now tell me, the way in which you audit accounting standard financial statements, will it be same as that you audit Indian accounting Indian accounting standard financial statements? The answer is no. The procedures that you will perform here in case of Indian accounting standard financial statements, they will be different. Understanding, because the accounting treatment will be different na. So as per the change in financial reporting framework, you have to change your engagement letter even though it is a recurring audit. Next, change in other reporting requirements. Other reporting requirements means, see, the main reporting requirement is reporting as per auditing standards. Apart from auditing standards, whatever the reporting requirement is there, all that it becomes other reporting requirement. Like for example, CARO reporting. CARO, is it required as per auditing standards? No, it is required as per Companies Act. So it is other reporting requirement. Next, reporting under section 143 subsection 3, reporting under section 143 subsection 1. Next, reporting related to internal financial control over financial reporting. All these are other reporting requirements, right? So if there is a change in these other reporting requirements, then also you will frame a new engagement letter and you will give new engagement letter to the management as per the changed reporting requirements. Got it? Yes, sir. So this is complete discussion with respect to chapter number 2, ethics and terms of engagement. So let me know if there is any doubt with respect to this particular chapter. I guess there are no doubts. You can let me know if there is any doubts. We'll be meeting in the next class with a new chapter, that is with the third chapter we will be meeting. Okay, let me know if there are any doubts. If there are no doubts, we will be leaving. Okay. Okay, I guess there are no doubts. I'll be winding up this class as of now. We'll meet you in the next class with a revision of new chapter. Until then, take care. Bye bye. See you.